Every major market decline is preceded by a period of deceptive strength. Retail market participants often assume that powerful momentum will continue indefinitely. They buy enthusiastically into the final stages of an advance. This belief in endless upward movement is the most expensive mistake in trading. The market structure appears robust, yet the underlying dynamics are shifting dramatically. This is the illusion that the Wyckoff method was designed to solve. It provides a structured framework for recognizing the transition from accumulation or markup into full distribution. Before continuing, please subscribe and leave a quick comment, even one word. This small action helps the algorithm show this content to more people. Wyckoff observed that large professional operators cannot sell their massive positions instantly. Doing so would crash the price immediately. They must distribute their holdings slowly, methodically, and without alarming the public. This calculated transfer of shares is called distribution. Distribution is the process where professionals sell their inventory to the uninformed public. It requires significant time, often spanning weeks or even many months. It is not a single event marked by one bad trading day. It is a defined structure composed of 5 distinct phases. This structure provides a crucial roadmap for anticipating the market's major turning point. It shows exactly when underlying demand is failing. It highlights when professional supply is entering the market aggressively. The purpose of distribution is to create the cause for the subsequent effect. The cause is the sustained selling by professionals. The effect is the sustained markdown phase that follows. This entire process occurs while the news flow remains overwhelmingly positive. The market environment is usually filled with bullish sentiment and high expectations. The market tops are created through stealth. They are created through deliberate action by the composite operator. The professional trader must look beyond the superficial price action and the headlines. They must understand the underlying relationship between supply and demand. The Wyckoff structure reveals the precise moments when the balance of power shifts. It shows the strategic traps set to catch late buyers. Understanding these 5 phases of distribution is essential for capital preservation and for identifying high-probability short opportunities. This structure is the key to predicting a genuine market top. The distribution structure represents the strategic unloading of shares by the composite operator. This process is the exact opposite of the accumulation structure. It occurs after a significant markup phase or a long period of rising prices. The composite operator requires liquidity to sell massive amounts of stock without crashing the price. If the professional sellers simply dumped their inventory onto the open market, the price would collapse instantly. Their selling strategy requires time and high public enthusiasm. Distribution unfolds in a defined trading range. This range provides the necessary period for the professional money to gradually transfer their holdings to the less informed public. The core mechanic is simple. Supply is engineered to overcome demand. Wyckoff observed that this process is hidden by highly volatile price swings. These swings are designed to confuse the public and maintain the belief that the upward trend is still intact. The professional seller needs buyers. They need strong buying interest to absorb the large selling orders coming from the top. Therefore, the composite operator must create the illusion of strength. They often allow the price to rally sharply, encouraging speculation and attracting momentum traders. These sudden bursts of upward movement provide the critical liquidity needed for the distribution to continue. When the distribution structure is active, demand is diminishing, even if the volume remains high. This diminishing demand is often masked by the concentrated selling efforts of the largest players. The distribution range serves as a critical battlefield. It is where the balance of power shifts definitively from the buyers to the sellers. The professional trader recognizes that the asset is no longer being accumulated for a future markup. Instead, the asset is being transferred from strong hands to weak hands. This transfer happens at increasingly high prices. The public is buying based on past performance and future optimism. The composite operator is selling based on valuation and the recognition that the trend is exhausted. Every rally within the distribution range should be viewed with extreme skepticism. These rallies are simply opportunities for the professional seller to offload more inventory at favorable prices. Understanding this mechanic, the slow, deliberate transfer of supply into the hands of eager demand, is the foundation for identifying a genuine market top. The structure is the cause. The subsequent markdown is the inevitable effect. The first critical step in recognizing distribution is identifying Phase A. This phase marks the initial stopping of the preceding uptrend. It is where professional interests begin actively transferring large blocks of inventory into the market. The first sign within Phase A is the preliminary supply. This event occurs while the underlying trend is still moving upward. Volume increases noticeably, yet the price gains are less impressive than they were previously. This indicates that supply is starting to absorb demand, slowing the rate of ascent. The market then typically culminates in the dramatic event known as the buying climax. This is often the most visible and emotionally charged move of the entire structure. The buying climax is characterized by intense price movement on extremely high volume. This surge is usually fueled by late-stage public participation, rushing in out of fear of missing out. The institutional sellers use this final burst of enthusiasm to complete their initial large-scale liquidation. The buying climax essentially exhausts the remaining strong demand in the market. Once this buying pressure vanishes, the professionals stop supporting the price. What follows immediately is the automatic reaction. This reaction is a sharp, swift decline from the peak established by the buying climax. The automatic reaction confirms that supply has temporarily overwhelmed demand. It demonstrates that the market's internal structure has fundamentally shifted from accumulation to distribution. The low point established during the automatic reaction becomes the critical lower boundary of the distribution trading range. The high established by the buying climax sets the upper boundary. Phase A concludes with a secondary test of the buying climax area. The price returns toward the high, but the resulting volume is typically significantly lower than during the climax itself. This test shows whether demand is still present at those elevated levels. If the secondary test fails to generate high volume or push convincingly past the previous high, it confirms the weakness introduced by the buying climax. The market has now established the initial parameters of the distribution structure. The stage is set for the long, complex process of building the cause in the next phase. Phase B marks the essential period of building the cause. This phase is typically the longest duration in the entire distribution structure. It is characterized by the market moving in a broad, sideways trading range. The primary objective of the professional operators during Phase B is calculated and systematic. They must sell their entire holdings into the remaining market demand. This selling must be executed without depressing the price too quickly. Wyckoff emphasized that the cause must be large enough to justify the eventual effect. The effect in distribution is the major markdown that follows. During Phase B, price repeatedly tests the boundaries established in Phase A. The upper boundary is defined by the high of the automatic reaction. The lower boundary is established by the low of the preliminary supply. Numerous rallies and reactions occur within these established limits. These movements are critical secondary tests. They confirm the persistent supply present in the market. When the market approaches the top of the trading range, professional operators increase their selling pressure. These rallies appear strong on the surface but consistently fail to sustain new highs. The failure to generate follow-through buying is a hallmark sign of distribution underway. The most telling secondary tests happen when the market attempts to exceed the prior peaks. These attempts are met swiftly by renewed supply. They demonstrate that the composite man is still actively distributing shares at higher prices. Volume analysis during Phase B is crucial for confirmation. As the structure matures, the volume tends to contract dramatically. The wide price swings seen in Phase A begin to tighten. This contraction signals that the supply and demand forces are temporarily balanced. but the underlying professional selling continues quietly. The professional operators are patiently absorbing the remaining demand at prices favorable to their selling agenda. They are systematically weakening the market internally. The repeated secondary tests at both the high and low of the range serve a dual purpose. They confirm the boundaries of the structure. They also shake out any weak-handed traders who bought during the initial excitement. The professional trader understands that Phase B is a waiting game. It is a period of persistent resistance and gradual erosion of market strength. The market remains range-bound, waiting for the final critical test that will signal the readiness for the markdown. That critical test occurs in the following phase. Phase C is where the professional money executes the final decisive move. This is the ultimate trap for the unprepared public. The defining event of this phase is the upthrust after distribution. This event is designed specifically to engineer a false sense of renewed bullish momentum. The market appears to break out of the established trading range. It decisively pierces the resistance levels set by the buying climax and the automatic reaction. Amateur traders view this price action as a sign of strength. They interpret the move as a genuine continuation of the prior uptrend. New long positions are initiated by those who fear missing the next rally. Stop-loss orders from existing short positions are also triggered immediately above the prior highs. This surge in buying volume is precisely what the professional traders require. They use this sudden liquidity to finalize their distribution process at elevated prices. The upthrust after distribution is characterized by its failure to hold the higher ground. The move itself is sharp and swift, often accompanied by strong volume as the trapped buyers enter the market. However, the price rapidly reverses course. It quickly falls back down, sinking below the critical resistance level it just breached. This rapid reversal confirms the underlying weakness of the structure. It confirms that the supply waiting at those highs was overwhelming. The inability of the price to sustain the breakout is the unmistakable hallmark of distribution. It demonstrates that the market lacks the true underlying demand necessary to support higher prices. The failure of the upthrust after distribution signals a profound structural shift. It invalidates the entire premise of the attempted rally. This specific event is critical because it captures the last remaining demand. It ensures that the majority of buying power has been exhausted just before the major decline begins. Wyckoff emphasized that this event is a final confirmation of the market's readiness to fall. It is the signature of the composite operator completing their work. If the price action remains within the range and fails to produce a clear upthrust after distribution, the structure may instead generate a final secondary test near the top of the range. This test confirms the lack of demand without the dramatic breakout. However, the upthrust after distribution is the most powerful signal. It is a clear warning that the structure is now fully prepared for the inevitable markdown. Once the price sinks back into the trading range following this deceptive move, the stage is set. The market then transitions into the next critical phase. The market transitions into Phase D. This phase is characterized by clear evidence that supply has fully taken control of the structure. The first major event in Phase D is the definitive sign of weakness. This occurs when the price breaks decisively below the support established during the earlier secondary tests within the range. This penetration of the lower boundary confirms the distribution is legitimate. It shows the professional money is now aggressively unloading shares. The previous support levels fail completely under the pressure of intense selling. The sign of weakness is not a small dip. It is a material violation of the trading range floor. This violation often occurs on expanding volume as the markdown accelerates. It signals that the effort exerted by sellers is finally yielding a significant result in price movement. The composite operator has successfully overcome the remaining pockets of demand. Following this sharp break, the market often attempts a counter-rally. This pullback is known as the last point of supply. It represents the final gasp of demand before the true markdown begins. The last point of supply is critical for the technician. It provides the opportunity to confirm that the breakdown is legitimate and not a failure. This rally is usually sluggish and lacks momentum. Volume often dries up significantly as the price rises back toward the breakdown level. The movement fails to return deep within the distribution structure. It does not challenge the area of the upthrust after distribution. Ideally, the last point of supply will test the underside of the broken support line. This previous support now acts powerfully as resistance. This confirms the change in polarity, a fundamental Wyckoff concept. The professional trader uses the appearance of the last point of supply strategically. It offers the highest probability entry point for initiating a short position. The risk can be tightly managed by placing a stop just above the peak of this weak rally. This provides an excellent risk-to-reward setup. If the market cannot sustain a rally above the former support, it confirms that supply remains dominant and demand is exhausted. Once supply is confirmed at this point, the path is clear. The market structure is fully prepared for the final, accelerating plunge into the next phase. Phase D acts as the final confirmation, setting the stage for the cascade. Phase E is the final, consequential stage of the distribution structure. This phase represents the effect derived from the cause that was meticulously built throughout the prior phases. The market is now completely free of the trading range. It enters a rapid decline known as the markdown. The most characteristic feature of Phase E is the acceleration of the downward movement. The price breaks conclusively below the support established during the prior secondary tests and the last point of supply. Supply has become completely dominant. Demand is virtually non-existent. This acceleration is often driven by a wave of panic selling. Those who bought late, believing the uptrend was endless, are forced to liquidate their positions at increasingly lower prices. Wyckoff emphasized that the professional trader must observe the interplay between price and volume during this critical phase. This brings into sharp focus the law of effort versus result. Effort is measured by the volume of trading activity. Result is measured by the magnitude of the price change. During the earlier distribution phases, significant volume was required to keep the price elevated. This high effort yielded a minimal upward result, indicating supply was secretly absorbing demand. In Phase E, this relationship reverses dramatically. The market now achieves large price declines with relatively diminished volume. This is the ultimate sign of structural collapse. Less effort is needed to push the price down because the market is starved of buyers. The path of least resistance is now undeniably lower. The price bars expand dramatically to the downside. The range of movement increases with each passing day or week. Any minor rallies that occur during Phase E are weak and swiftly rejected. These small counter-trend movements are simply retracements known as minor last points of supply. They offer fleeting opportunities for professionals to add to existing short positions before the next cascading leg lower. The market structure has transitioned from a stable, consolidating environment to a volatile, bearish trend. The goal of the distribution cycle has been fully met. The composite operator successfully distributed inventory to the public at high prices. The market is now moving toward the price levels where the next cycle of accumulation can begin. Phase E confirms that the entire structure from the preliminary supply to the upthrust after distribution was an accurate forecast of the impending price collapse. The entire distribution structure is built upon the interaction between price movement and trading volume. Wyckoff emphasized that volume represents the effort applied by the professional operators. Understanding this effort is critical for confirming each phase of the structure. During Phase A, the massive spikes in volume around the preliminary supply and the buying climax signal tremendous effort. This effort is necessary for the professional operators to absorb the public's frantic buying interest. They must sell large blocks of shares into this demand. Once the initial shock of the buying climax passes, the market enters Phase B. Volume typically contracts during this period of consolidation. The market becomes dull. Low volume during Phase B confirms that the major professional selling is happening without attracting undue public attention. The price is being held in a trading range while supply is systematically being placed onto the market. This quiet absorption is disrupted during Phase C. The volume action here is often deceptive and highly significant. The critical trap, the upthrust after distribution, frequently occurs on high volume. This high volume shows the substantial effort required to push the price just above the established resistance line. The professional trader recognizes that this high effort yields poor results. The price fails immediately after the push. It cannot sustain the breakout, confirming that the move was simply a liquidity grab to trap late buyers. As the structure progresses into Phase D, the relationship between volume and price confirms the shift from potential weakness to confirmed weakness. The breach of the support line, or the breakdown of the trading range, must occur on noticeably expanding volume. If the market collapses on low volume, the move might be a false signal or a temporary shakeout. Sustained high volume on the downside break confirms that the professional operators are committed to the markdown. This volume indicates overwhelming supply entering the market, overcoming any remaining demand. This dynamic illustrates the law of effort versus result in its purest form during distribution. In the early stages, high-volume rallies produce minimal upward progress. This is great effort with poor result, a clear warning of internal weakness. Later, modest volume on the markdown produces substantial price movement. This is minimal effort creating great result, confirming the path of least resistance is now lower. The professional trader uses volume as the ultimate confirmation tool. It validates the distribution schematic and removes the uncertainty of subjective price reading. Volume reveals the true intent of the large operators at every critical turning point. The identification of specific entry points transforms the Wyckoff structure from a theoretical map into an actionable trading plan. The professional trader seeks locations where risk is minimized and the potential reward is maximized. These locations are defined by the schematic structure itself. There are three primary high-probability entry points within the distribution structure. The first and most aggressive short entry occurs following the completion of the upthrust after distribution in Phase C. This move is designed to trap buyers above the established trading range. The price must quickly fail back into the range, confirming the trap. This entry offers an excellent risk-to-reward ratio. However, it demands significant anticipation and tolerance for volatility. The stop loss is placed strategically just above the high of the upthrust after distribution. The failure of the trap must be swift and decisive to validate this early entry. The second and arguably most reliable entry point occurs at the last point of supply. This critical maneuver happens in Phase D, after the initial break of the trading range support. The break confirms that the large operators are no longer defending the lower boundary. The price then attempts a rally back to this broken support level. This exhausted rally is the last point of supply. It represents the final attempt by demand to recover the market. Confirmation is absolutely essential at this point. The move back to the broken support must show diminishing volume and narrow price spreads. This lack of effort on the rally confirms that supply has overcome all remaining demand. The short entry is executed as the price turns lower and leaves the area of the last point of supply. The initial support line now acts as powerful resistance. This provides a clear, logical location for placing the stop loss, typically just above the new resistance level. The third and most conservative entry point occurs upon the final confirmation of the trading range breakdown. This happens when the price decisively drops below the low established by the last point of supply. While this entry sacrifices some profit potential, it maximizes certainty. The market is now clearly committed to the markdown phase in Phase E. The professional trader ensures this final breakdown is accompanied by very high selling volume. This volume confirms the commitment of the large sellers. It signals a fundamental shift in market control. These 3 points, the upthrust after distribution failure, the last point of supply, and the final breakdown, provide a systematic method for entering the market. They are all based on the structural weaknesses exposed during the distribution process. Trading the distribution structure requires patience and discipline, waiting only for these high-probability setups to materialize. The strategic mindset demands exceptional control. The professional trader recognizes that distribution is inherently volatile. Price action near the market top is designed specifically to confuse and trap participants. Risk management, therefore, is the foundation of the entire short-selling strategy. It supersedes the entry point itself. Capital preservation is the highest priority. The trader must always accept that the market action is correct. If the price violates the structural high, if it moves above the upthrust after distribution, the short thesis is likely invalid. A protective stop-loss order must be utilized without exception. This single rule prevents catastrophic loss of capital. The structure provides the necessary coordinates for both entry and exit. The structural high of phase C, or the last point of supply, dictates the precise stop-loss placement. Never attempt to average down a losing short position. This practice multiplies risk precisely when the initial trade is failing. It demonstrates a fatal bias against the market's own evidence. The professional accepts the small loss and exits quickly. Wyckoff's core philosophy emphasizes that trading is a serious business. It is not a speculative gamble based on hope or rumor. It requires dedication, objectivity, and the rigorous application of defined rules. The professional judges the market solely by its own action. This means analyzing price, volume, and the reliable relationship between the two. No outside news or personal opinion should influence the decision to enter or exit a position. This systematic approach transforms speculation into calculated risk-taking. It allows the trader to wait patiently for the definitive signs of weakness in Phase D and Phase E. The goal is not rapid profit but consistent execution of high-probability setups. These foundational principles established by Wyckoff remain essential today. They bridge the gap between historical market study and modern execution. For those committed to mastering this methodology, the recommended resource is How I Trade and Invest in Stocks and Bonds. It is critical to study the annotated edition by Max Davidson. This edition clarifies Wyckoff's original teachings for the current market environment. It emphasizes treating trading as a serious business, the absolute necessity of limiting risk through stop losses, and the fatal error of averaging down losing positions. The material stresses judging the market purely by its observable action and maintaining capital preservation as the primary duty. The link to this book is in the description below. Applying these structural principles will fundamentally change how market tops are perceived and traded. Success in the market comes from understanding the actions of the large professional interests. It requires discipline to trade only alongside them. You can watch hundreds of hours of content and read dozens of books about the market. You are filling yourself with knowledge, which is excellent. But knowledge alone won't make everyone rich, because not everyone possesses the right foundation. The market is the same for everyone. The only difference lies in the mindset. You can have a perfect trading system, but if you lack discipline and an understanding of your own psychology, that system is worth nothing. I often see a recurring theme in your comments. It is easy to talk about strategy and theory, but when it comes to the actual trade, many struggle with emotions. For those who want to focus on discipline, patience, and self-discovery within trading, I have created a new channel called The Stoic Trader. I believe it will help many of you bridge these gaps. So if you think this kind of content would be useful to you, go ahead and check it out. The link is, as always, in the description below.